If you've been unemployed for half a year, you very likely would have sapped your savings. Depending on how much your savings were, 3 months, 6 months, you would have burned through a lot of it and you may have to start using lines of credits. And when you layer this on with mortgage delinquencies, which is the orange line over here, you can see it's a pretty close match. Do you see that? So you can see the only reason why over here in 2020, when we had unemployment rates spike up like crazy over here going this way, and why delinquencies went down this way, is because we have major stimulus from the government that came in and propped everything up. That was free helicopter money, CERB, and all that jazz. And now you can kind of see over here that if our unemployment rate is going up where people are unemployed for 6 months and above, the delinquency is also going to be going up. Bank of Canada decides to hold their interest rates at 2.75% yesterday. It was a 50-50 chance, so a toss-up essentially, of whether they were going to cut or hold. The fact that they held may have surprised some and may have not surprised others, depending on what they're trying to go for right now. But here's kind of where the important thing lies. All of this stems back to what I've been saying for the start of the year. There's been a lot of uncertainty, and with all this uncertainty, there's been a big pause. So in this video, I'm going to give you my base case of what I think is going to happen, and I'm going to show you the data and charts to how I arrived at my own base case. Plus, I'm also going to show you how the numbers are looking so far since we're in the middle of April, and I can tell you, it's a pause. Things have really paused. So make sure you stay tuned to see what exactly is happening real time in the real estate market, given all the turbulence that's happening. Hi, my name is Zen, and if you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. So I'm going to start off by showing you what other dates are coming up next for these, rate announcements. And you can see over here, the next one is in June 4th, right there. Now, you have to understand the frame of mind. April generally is when things start picking up because of spring market. And June 30th, usually when the kids are out of school, is when things kind of settle down. So we've had a slow start to spring, and now with the rate pause, you can see it's probably going to take some wind out of the sail for the spring market. And because the next one's in June, it'll pretty much be towards the tail end of it anyways. I do not think it's going to make a difference on the sentiment. And anyone who's looking at these dates and hope that it signifies a start or a reversal of the sentiment, I think you should not have that thought process anymore, because we've had multiple rate cuts already in the last year here, and it hasn't changed the sentiment, because the bigger fish to fry that we're all looking at right now is Trump, our election, and all the trade wars that US and China are having right now. So those are bigger problems than the Canadian real estate market. And the head of Bank of Canada also says the exact same thing. Now I'm going to show you a little clip from their presser yesterday, and they outline 2 scenarios of what they think is going to happen, and I'm going to give you my comments on that.
Looking beyond the near term, what happens to the Canadian economy and inflation depends critically on U.S. trade policy, which remains highly unpredictable. Given this uncertainty, point forecasts for economic growth and inflation are really of little use for anything.
So I like that he addresses the fact that forecasts are pointless as well, including his.
In scenario 1, we assume most of the new tariffs are negotiated away, but the process is unpredictable and businesses and households remain cautious.
So this is probably the best case scenario, that trade war is over, and he says that there's minor GDP growth and no inflation. That's the best case scenario.
In scenario 2, we assume a long-lasting trade war. The economic consequences are severe. Canada's GDP contracts in the second quarter, and the economy is in recession for a year.
So this scenario is a worse scenario. But one of the things that I've had as part of my base case is that I think we're going to go into a fairly deep recession, because our economic data, even prior to the trade war, was very, very bad. And we layer our bad economic data, which I'm about to show you, on top of this trade war. One of the scenarios he isn't talking about is a deeper recession. This is what we have to watch out for. So the first chart I'm going to show you here is an index of the consumer confidence. And you can kind of see right over here, we're very, very low, right? Meaning the consumer is not very confident. We are now lower, and like I said in the last video, than during the pandemic, which is really, really bad, meaning that people are less likely to be spending if they're not confident in the economy. The second one here is the business confidence. Exact same thing. You can see over here. it is lower than the pandemic, actually significantly lower. And you have to keep in mind, small businesses provide a lot of jobs, and they're also the ones that are also importing and exporting a lot of things. So if this isn't looking great, then that means the entire, call it population, small businesses and consumers aren't feeling hot right now. Now, here's the second component that I think a lot of people haven't spoken about, which is what the price expectations are from a business perspective. And this is what they're tracking over here. So the CFIB is almost call it like a survey where people are asking, hey, where do you think prices are going to be in the future? And you can kind of see over here that small businesses think that we're going to see the inflation, the average core inflation, go to 4%. And you can see in this trend line that the orange trend line more or less follows the expectations. Right now, the inflation is a little bit over 1.5%. And if the expectation is going to be up here and going this way, where do you think core inflation is going to be going in the near future? Higher. And in this chart over here, this talks about the consumer inflation expectations. Right now, we're at about 3%, and most people are actually expecting that it's going to go higher. We're going to get to about 4%. Which means that it could be a self-fulfilling prophecy, but most people are expecting prices to go up. Whether that's because of tariffs, inflation going up, it doesn't matter. If everyone is expecting inflation to go up, it tells me that a lot of people will be behaving in that manner. So this is my base case and what I'm planning to do. I do expect that there probably is going to be additional rate cuts coming, whether that's because it's an emergency rate cut because of a trade war or because economic data is really bad, especially as you saw with the unemployment. But I do think rate cuts are coming. Let's say overnight rate goes down to 2%. I don't know where fixed is going to ultimately end up, depending on where the bond market is. But I do think that a little bit after that, we're going to start seeing inflation. And that could just be maybe trade wars are kind of settled. Maybe we do have some trade agreements. Maybe we don't. I do think that we're going to experience that weaker currency inflation that's going to be coming in. And I do think that the global trade is actually going to be really messed up after all of this as well. So I do expect inflation to rise and the input costs to also increase. So therefore, I do think interest rates are going to go up as well. So what that means is if you are holding a mortgage and trying to lock in, you may have another opportunity to lock in if my base case is correct. And as for where the real estate market sales are going to be, let's say interest rates get back to, call it the mid fours. If there is uncertainty, the rates won't matter. Whether it's mid fours, mid threes, I don't think it's going to matter. But let's say the uncertainty is over and the market reverts back to the norm. At a 4.5% mortgage rate, I think the market will move again. Sales would be obviously better than now, but probably like a little bit below the 10-year average. Nowhere close to the 2021 or like pandemic kind of experience. I don't think we're going to get back there ever again. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. And here's another problem with our economy. The Toronto unemployment rate, so like GTA, is higher than all of Canada. And I think a lot of people are not talking about it. So if you look at our number right here, you can see we're at like 9%, which is very, very high. So that's something we really have to watch out for, because it's not that prices will come down or sales are going to come down in the Toronto real estate market. It's people are going to have to fire sell their property if they burn through their savings after they lose their jobs and they can't find another job. That's a big problem. And that's what a lot of economists are worried about. And here's the scariest chart of them all, and why I kind of want to illustrate all of this to you slowly, one at a time. You can see in this chart over here, the blue line over here recommends the share of unemployed for 27 weeks. 27 weeks is half a year. The reason this is important is that if you've been unemployed for half a year, you very likely would have sapped your savings. Depending on how much your savings were, 3 months, 6 months, you would have burned through a lot of it and you may have to start using lines of credits. And when you layer this on with mortgage delinquencies, which is the orange line over here, you can see it's a pretty close match. Do you see that? So you can see the only reason why over here in 2020, when we had unemployment rates spike up like crazy over here going this way, and why delinquencies went down this way, is because we have major stimulus from the government that came in and propped everything up. That was free helicopter money, CERB, and all that jazz. And now you can kind of see over here that if our unemployment rate is going up where people are unemployed for 6 months and above, the delinquency is also going to be going up. And this isn't to scare you would say that, hey, look, delinquencies are going to get up to here. Because if you keep in mind, 0.4% of delinquencies is still relatively very, very low. Because if you draw this line all the way out through over here, it's like bringing it back to average. But that doesn't mean it's going to be a small impact, because if you have people who do have to fire sale their property and you have people who are on pause and they're not doing anything because the trade wars go longer and there's so much uncertainty and nobody wants to buy $1 million home, then those people who have to sell are going to be dropping their prices. And in residential real estate market, your value of your home is based on the last sale that's comparable to yours. So if your neighbor loses their job for 6 months and then they have to fire sell their home and it's 5% lower than the last property that sold, call it last year in December, then the value of your home just went down to whatever the neighbor fire sold their home for. And that's the problem we are experiencing right now, and why I'm a little bit concerned for where the real estate market is headed. Now, there are always two sides of every trade, and I'm going to illustrate this for you. And while we can say that, look, the delinquencies are going to go up, you can also see exactly over here that the cost to own your property on a monthly carrying basis, and which is what most people care about, is going down because prices are going down, interest rates are going down, which means that we are slowly reverting back to, call it slightly before pandemic cost to carry because interest rates are coming down. And this is why I said there's always two sides to a trade. If you are not affected by the trade war, and I've said this in many past videos before, this actually is a good time to take advantage because these are very good conditions to be a buyer. Thinking about buying a home, but not sure where to start or what's even a good deal? Just hit the link in the description below and tell me what you're looking at, and I'll send you real-time feedback. No bots, no BS, just sharp insights to help you outsmart the competition. But again, this is all predicated on whether you're going to keep your job, you have confidence in keeping your job, and what your risk tolerance is. And that's what I'm saying. It isn't for everybody. But what I can tell you anecdotally from our business is that we have buyers who have purchased properties that were 5-6% lower than what the last comp have. We've also sold properties where we sold it for 5-6% less because they wanted to sell and they didn't feel that they want to hold on to the property. So this is exactly what I meant. There's always two sides to the trade. It just really depends on your unique personal situation. And this chart is to illustrate you kind of where the market is right now. And remember, like I was saying, there's two sides to the trade. You can choose to be on the buyer side or choose to be on the seller side. But this is just data for you to understand and apply it to yourself. Whether you're bearish or bullish, it doesn't matter. It's just where the market is. And you can see exactly right now, we're halfway through April. These stats go into April 15th. And we right now are contracting almost less sales than we would have had during the pandemic, which is right over there. It's very low. So let's say we double this up and we get to, call it over here, maybe we get to 4,000. We're going to have like the second lowest April sales out there. And that's because there's a lot of uncertainty. This is exactly what I'm talking about. Depending on which side of the trade you're on, this could be advantageous for you or disadvantageous for you. You just have to understand your own situation. This is what April numbers look like so far. And I want to illustrate to you because, again, every segment is behaving differently, and depending on what you're trying to do, buy and sell, you're going to have a different result. So let me show you. So let's start with the detached. You can see over here that a third of the properties are selling above list price. It doesn't matter if it's $1 above list price or $2 above list price, it's still selling above list price. And generally, even though there may be one or two offers on OfferNet, you're only selling above list price if you have competition or someone really wants to buy your home. And you can see that the average sold price divided by list price is 101%. It's very close to 100, but it's just to show you there is somewhat of a competition. This is generally how Toronto real estate market has generally worked. It's kind of like a fairly moderate seller's market. And that's why this doesn't surprise me. Now, if I go into the condo segment, a lot of the condos right now are not performing very well. Only about 13% of them are selling over list price, which is very, very little. And the average sold price divided by list price is 98%, which tells me, and is what I've been saying a lot, you can go and set a new floor if you find a seller who's desperate enough. Generally, it would have been closer to 100%, but now you're down 2% or maybe 3% from the 101 and detached. It's to show you that, look, there are opportunities here as a first-time home buyer or as an investor. If you can find a seller who's likely afraid of what's happening, you could make a move on your property, and you haven't had these kind of conditions in the market in a very, very long time. So I would say, again, if you're not affected by the trade war, this makes sense to take advantage of high supply in the condo space. People are expecting less price. You can set a new floor. Makes total sense. Now, the other segment I've been talking about is the entry-level freehold space. So these are your ground-based homes that are generally 3 bedrooms. And surprise, surprise, you can see 44% of them are selling over list price. I'm not surprised, but I've been saying this a lot. A lot of people are trying to get into the freehold space. A lot of millennials who have had kids in the last little bit are trying to get into a good public school. And the very savvy real estate owners understand this. Condos may be flat for the next 5 to 7 years, adjusting for inflation. But if you can see that we're seeing appreciation in the entry-level freehold space, and again, 3 bedrooms, 800 to call it 1.5 mil, depending on where you are in the city. If that's appreciating, it means that the gap between your condo to your freehold, your entry-level freehold, is getting bigger and bigger. If you want to get into entry-level freehold, do it now, right? So a lot of savvy people understand this, and that's exactly why people are selling their condos and getting into freehold space. And this is also exactly why this is very competitive. You can see all the listings are selling 103% over list price. There is a significant amount of competition in this space, quite a lot. So as you can see, depending on what you're trying to do, whether you're trying to enter the entry-level freehold space, the condo space, or the detached space, it's a totally different type of market. And if you're buying and selling one property to another, it's also different. So if you're going from a condo to an entry-level freehold, selling is hard, buying is hard. But you should do it because the price gap is getting bigger. If you're trying to downsize and go from a detached to a condo, you're laughing, you're winning. Or if you're trying to go from an entry-level freehold to a condo, you're laughing even more because you're taking advantage of how the market is going. But again, every single person is different depending on their personal situation, what they're affected by the trade wars, and what they're trying to do in life. The market moves. It's frozen and paused because people are uncertain. But those who need to move are still moving. So if that's you, make sure you give me a call to understand how all of this economics, the Bank of Canada rate cuts, the current data, and how the sentiment on the ground right now is to fully understand what your position is. Because there is no blanket statement about the real estate market is X. One blanket statement of X just does not exist. And if you're on the sidelines right now, but you feel that the trade wars aren't going to negatively impact you and you want to look at what is available right there right now, can you take advantage? Can you buy things with conditions? And can you set a new floor like some of our clients right now? You can check out this video I have over here talking about the advantages of being a first-time home buyer right now and why, if you're not affected by the trade war, it is a good opportunity to really consider looking right now. So make sure to check out that video over here. And until next time, your move, your future. See ya.